All right, today we're diving into the latest numbers from Public Service Enterprise Group, or as you probably know them, PSEG. Think of an earnings report like, well, it's basically a company's checkup, right? It tells you how healthy the business is, how they did, and what they think is coming down the pike. And for a huge energy company like PSG, yeah, this is a really big deal.
So that's the million-dollar question, isn't it? After a year with some pretty crazy weather and all sorts of economic ups and downs, how did PSEG actually hold up? Well, let's not waste any time. Let's get right to the answer.
Boom! There it is, the big headline number. PSEG pulled in non-GAAP operating earnings of $4.05 per share. And look, that's a seriously strong performance. We're talking about hitting the very top end of what they predicted, and it's almost a 10% jump from the year before.
But a number like that, it's just a number. It doesn't really tell you the whole story. So let's get into what was actually happening on the ground to get to that solid result.
And really, that performance, it starts with people. The CEO, Ralph LaRosa, he made a real point to thank the crews. The folks who are out there in freezing cold, dealing with heavy snow, 60-mile-an-hour winds, all just to keep our power on. It's a great reminder that behind all these big corporate numbers, there are real people doing the hard work.
And all that hard work, it absolutely paid off. I mean, check this out. For the 24th year in a row, they snagged a huge award for reliability. J.D. Power ranked them #1 in customer satisfaction. And on the green front, they slashed methane emissions by over 30% compared to 2018. Oh, and their nuclear plants, they were just humming along, running at over a 91% capacity factor. Just incredible.
So here's the thing you got to understand. This wasn't just a lucky year. For PSEG, delivering on what they promise, well, it's pretty much a habit. This is the 21st straight year that they've met or even beaten their own financial goals. I mean, that's just an amazing run of consistency.
Okay, so a great year is in the books. That's awesome. But for anyone paying attention, whether you're a customer or an investor, what really matters is what's next, right? So let's pivot and look at what the company is planning for the future.
And they are definitely not resting on their laurels. PSG isn't just trying to have another good year like 2025, they're actually aiming quite a bit higher. Their guidance for 2026 points to earnings that are going to be noticeably better than what we just saw.
I mean, this just screams confidence. If you look right at the middle of their projected range, PSEG is expecting about 7% earnings growth for 2026. That's not just treading water, that is hitting the gas. And look, they're backing it up with cash. The company just announced they're bumping up the annual dividend to $2.68 per share. That is a loud and clear signal from the top brass that they think these strong earnings are the new normal. And this isn't just a short-term thing either. They've actually boosted their long-term forecast too. They're now projecting 6 to 8% earnings growth every single year through 2030. So that begs the question, how on earth are they going to pull that off? Well, the answer is pretty simple actually, and it's all about a huge investment plan. PSEG is getting ready to pump tens of billions, with a B, of dollars into their infrastructure over the next 5 years. And the scale here is just mind-boggling. We're talking about a plan that's somewhere between $24 and $28 billion. And this isn't just patching things up. No, this is a top-to-bottom modernization of the entire energy grid. So, where's all that cash going? Well, more than 90% of it is going into what's called regulated investments. Basically, think of stuff like upgrading power lines, replacing old gas mains, the core infrastructure. These are the kinds of projects that give you really predictable, stable income because regulators have already approved them. It's a much safer way to grow. And all of this spending is designed to do one key thing, which is really the heart of their strategy. They want to grow something called the rate base by about 6 to 7.5% every year. Okay, so what in the world is a rate base? Look, it's simpler than it sounds. It's just the total value of all the stuff a utility owns to get power to your house. The poles, the wires, the pipes, all of it. Regulators basically say, okay, you can earn a certain profit based on the value of all that stuff. So when PSEG invests in new and better equipment, their rate base gets bigger, and that means their potential earnings get bigger too. It's really the basic business model for a utility like this. All right, so we've gone through the numbers, we've talked about the operations, the strategy for the future. But let's be real, why should you care about any of this if you're not a Wall Street analyst? Well, here's the bottom line.
If you're a customer, all this money they're spending means a more reliable grid to keep your lights on. It also means more clean energy projects. And this is a big one. They're actually working to keep costs down. They're pointing to a bill reduction of almost 2% for electricity starting in June. Now, if you're an investor, it means you've got a really clear, predictable roadmap for growth, a dividend that's going up, and a financial plan so solid they don't even have to sell new stock to pay for it all. And all of this really leads us to one final huge question. This whole report from PSEG makes it crystal clear just how much money it's going to take to get our grid ready for a future full of electric cars and clean energy. But it also throws a spotlight on the #1 challenge for pretty much every utility out there. How do you possibly spend billions and billions building the grid of the future while making sure energy stays affordable for everybody right now? That is the tightrope they're walking, and really that we're all walking for a long, long time.